Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. Just want to talk about an article that came out yesterday, and I'll link the article in the description for you to read up on this. But basically, it says World Bank makes a big cut to its 2023 growth outlook, and basically says that the globe is very close to tipping into a recession. Now, if I scroll down in this article, it basically says the adjustment was led by a significant downgrade to its prospect for the U.S. economy. It now forecasts 0.5% growth from an earlier projection of 2.4%. The World Bank cut its growth outlook for also China for 2023 from 5.2% to 4.3%, Japan from 1.3% to 1%, and the Europe and Central Asia from 1.5% to 0.1%. So guys, there, the World Bank is coming out, cutting their projections of growth. I won't be surprised if later in the year that even they cut their growth projections even further, right? This is just the beginning. We're seeing it in the data. We saw it in the last ISM report where the number came in below 50, signaling a contraction in the services economy, and the numbers are starting to deteriorate. A lot of the leading numbers as well, the leading data out there is also signaling that we are already in a recession. However, when you look at the jobs data, when you look at the employment numbers, when you look at also the inflation numbers, which we're going to get tomorrow, the CPI report in the US, the numbers still are lagging. They're lagging behind. They don't seem like, they're worse off. Like jobs are still doing well. It's still robust. The CPI numbers are, still elevated, not at the 2% level, right? So you've got this leading data telling you that, hey, we're in this recession, right? You've got the World Bank basically coming out and saying cutting their growth forecast, right? And then you've got the lagging numbers which the Federal Reserve is looking at and relying on and making their decisions on, and saying that we're going to see a soft landing. And I just don't see that. I just don't see a situation where we see a soft landing in 2023, especially when you have the Fed looking at lagging numbers, lagging indicators, while the leading numbers are showing a very, very different case. When also you're seeing leading indicators showing contraction in its growth numbers and its orders, and even in some of the prices components. When you look at the ISM numbers and non-manufacturing and the manufacturing numbers, you're seeing the prices component has come off quite a bit and aggressively, right? Yet the CPI has yet to come off. So it'll be very interesting to see how CPI number comes out tomorrow. Now, as I go through this, it also says that the downgraded estimates would mark the third weakest pace of growth in nearly 3 decades, right? Overshadowing only by the global recessions caused by the pandemic and the global financial crisis, right? So the numbers that we're seeing right now, and the fact that the Federal Reserve and some central banks are saying we're seeing a soft landing, these numbers are very weak to a point where it takes us back to the great financial crisis back in 2008, where those numbers were very horrendous and very ugly, right? And this is just the sign. This is just the beginning, right? There was just an article also that just came out a couple minutes back about BlackRock cutting their employees, about 500 of them. And then you had Goldman Sachs basically looking to cut their employees as well for this year. And now, of course, you're not going to get these companies react to a situation right away. They're not going to right away cut employees, but they will look at the situation. They will not make a bet on the economy until the situation unfolds, until they really start to see that their bottom line is not being met and is worse than expected. Then yes, they will cut off, and you'll see more job losses in the year. And probably, I expect to, you might see the results of all of that tightening that we've done in 2022 and the job cuts and the job layoffs more as we approach to the end of the year. So it's going to be quite of a wild ride, and very important that you take note that the World Bank is mentioning this, even though you have certain central banks, like aka the Federal Reserve, coming out and saying that the economy is still strong, soft landing is still doable, and etc. and etc. Right? And now, when I go through this article also, and I scroll down a little bit here, it talks about China. China being a key variable, right? It says a faster than expected China reopening poses great uncertainty for its economic recovery, the World Bank said in its report. And if I scroll down a little bit more, it says China's big enough by itself to really lift global demand and supply. And this was a comment by, I guess, one of the I guess from the president of the World Bank, and he basically says this: why China is a very key variable is because now that China is reopening, the economists are expecting that the reopening that's coming from China is going to uplift and bring in more demand as they travel more, and it's going to level maybe the supply and demand curve, as maybe supply chain may get may start to ease a little bit more better than what it was before. And also, not only you got more demand, you got people going out and purchasing, but that may help uplift, because China is such a big economy, help uplift the globe in terms of heading into a really severe recession. Maybe it won't be as bad as China recovers, right? So the recovery story is yet to be seen in China, especially because there's still a lot of uncertainty, especially with this COVID and the COVID rules. If things start to pick back up again in terms of more cases in COVID, then sure, definitely, maybe China may slow down certain things. People may not be going to work or decide to, stay at home. Even as maybe the Chinese government may think of giving out stimulus, and workers may not need to go and work, which will also still disrupt the supply chain. The other caveat to the opening of China is also the idea of, if demand comes in and there's still a supply constraint that's happening, then prices will still move up. So if there's a demand for oil, the oil prices should go up. Yet we haven't yet seen that from the news that we're seeing with China reopening. We haven't seen a massive a spike in oil, which is very interesting to see. But that's the expectation, is that, if China reopens and everything's fine, then we should start to see prices move up, which is not a good thing. Which you could anticipate or expect that if prices move up higher again, guess what? Jerome Powell is going to go out, and a lot of the central banks out there are going to go out and continue to tighten harder and harder. Just look at the European Central Bank. Right, the European Central Bank came in with a surprise, saying that they're going to hike rates more than expected. They want the rates to go above the inflation rate, which matches the Taylor rule, which Bullard was talking about before, where you have rates above the inflation rate. And the ECB is saying that we see inflation around 4% this year, and we can get rates maybe around that level or higher, which would basically bring inflation down. Now, with all the central banks out there continuing with their tightening, and if prices continue to move up, if oil does another leg up, another spike, does not look good. That means inflation numbers will look hideous in the next coming reports. The stock market should not be taking that in a light way, and in a good way, and you will see probably sell-offs in the equity market if oil decides to have a massive spike. Because that will just mean one thing: the Federal Reserve and the central banks are going to do more tightening. So let me know what you guys think. Leave a comment below, subscribe, hit the like button as well, and the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.